Hello friends, in this video we are going to do a portfolio review, and one of our viewer has sent his portfolio to us wherein he says that he watches the video on daily basis and he wants to hold the portfolio for 10 to 15 years and he wants some suggestion on any stocks that need to be removed, and the total number of stock that he currently has is 26, and every month he plans to add 5,000 rupees to the portfolio, and he has mentioned that his expectation is 16 to 20% CAGR and he wants some suggestion if there are any changes to be done in the portfolio. So let's start. So here you can see that the invested amount is 1,84,000 and currently the value is 1,63,000 and the portfolio is down by around 20,000 rupees and the number of companies are 26, which obviously is very high looking at the size of the portfolio. First company is Carousel, and here he has invested almost 14,000 rupees and the amount is down by 30%. It is a very small cap company with a market cap of close to 1,000 crores, and this is into the business of manufacturing stainless steel sinks, bath products, etc. I've checked its financial. The financials are okay, average. The company has recently started giving good profit. If this company is able to sustain the growth that it has shown in last 2-3 years, then it can give you good returns in future as well. But in case if it is not able to sustain, then in this company you might also get stuck for a very long time. Thus this is a very small company, so the investment amount you should be doing for these type of company should be very limited. Currently you have given an allocation of 7.5% to this company, which according to me is on the higher side. So in this company you will have to track the numbers very closely. If you see the numbers growing, then continue with this company. If you see them falling, then you will have to take a decision as well to move out of this company. Next company is FL India. This is a good company in the small cap area. You can continue with this company. Next company is Bajaj Finance. This is a very good company. You can continue, and whenever you get more opportunity in this company, you can think of adding more quantity as well. This is the type of company for which you can keep your allocation to 10%. Right now it is at 6,000 level. You can think of this level as well. In case if it goes further down to 5,500, then you can add one more quantity. Next company is Berger Paint, and this is also a good company in the paint sector. Currently it is showing a negative return of 7% in the portfolio, but you can continue with this company and hold it for long term. And in this company also, if you want, you can increase your allocation to maximum 10%. Next company which he has is Kaplan Point, and in this company he is currently down by around 7.27%. So this company is from the pharma sector, and if you will see that in the period of 1 year the returns are negative, which is still okay, but in the period of 5 years also the returns has not been very great. It's just 9% return that has provided in the period of 5 years. One important thing that we need to note is that if we are looking to make return of 16 to 20%, then we need to have companies in our portfolio who are giving these returns on continuous basis. And this company I don't think is going to help your portfolio get those returns. One is because of the return profile. Second is because it belongs to the pharma sector, in which there are a lot of regulation. In case you want to go with any company in the pharma sector, you can try Divi's Labs or you can go with Dr. Lal Pathlab. They both have provided good returns to its shareholder in the long term. Next company is CDSL, and currently he holds 5 shares and currently there is a loss of 12%. This is a good company. If you want, you can continue with this company, but only if you can handle the fluctuations, because these type of company will do very well during the bull run, but whenever there is a consolidation phase, then these company may not provide you good returns. So if you are looking for a consistent compounder type of company, this company does not fit there. Next company is Deepak Nitrate, and he has 5 quantities and currently facing a loss of 14%. This is a good company. This company is the leader in the sodium nitrate business, so you can continue with this company. Next company is HAL, and the quantity is 1. And the return are 67%, which is superb. Now here guys, you will learn one thing, which is the allocation. So for HAL, he has picked the share at the right level, and the company has shown very good run up and has become a momentum stock and has provided very good return as well. But these returns are not actually helping the overall portfolio much. Why? Because the capital allocation is very less. If you will buy just 1 or 2 shares of the company, then it is not going to make much difference to your portfolio, even if they become 2x, 3x. That's why it is very important to limit the number of the companies in your portfolio and also do the allocation properly, so that in case any company in your portfolio provide good return, then at least it provides some boost to your portfolio. Next company is Happiest Mind, and the quantity is 10. Currently there is a loss of 25%, which is fine. You can continue with this company. It's a good company, but you'll have to hold it for long term. Next company is HDFC Bank, and the quantity purchase is 3. Again, you'll see the same problem, that the company that he has purchased is good, but the quantity is very less. And you'll see that it is also providing a return of 8%. So in this company also you can increase your capital allocation so that in future it provides good return and also increase the overall portfolio return for you. Next company is Polycab, and again the same problem here as well. Just 1 quantity has been purchased and the return has been around 8%. This also is a very good company, a market leader in wires and cable sector. This company also you can focus on and start increasing the allocation as and when you get the opportunity. Next company is Reddington, and in Reddington he's getting a positive return of 26%. Now for this company, if you'll see the 5-year return, you'll see that the returns are okay, not that great as well. Around 14 to 15% CAGR return this company has provided. And that has been possible because in the last 2-3 years, company's profit has increased by a good percentage. If I look at the maximum return for the company, you will see that the company from 2007 till now has only provided 1000% return. And in this company, there have been massive falls as well. You can see here that the company has earlier fallen by 63% also, and this is all before COVID. And you'll see that this company has also fallen earlier as well by 76%. So if you want to be invested in this type of company, you should have very strong conviction on the company's business, because handling a downfall of 50-60% is not an easy job. And that's the reason I kind of always advocate for consistent compounder share, for market leader share. And those market leaders can be the large cap company also, or if you want to go with mid cap and small cap also, try to find market leaders in those sectors. And the reason for selecting market leaders for most of the companies in your portfolio is that you will be able to hold those companies, because those companies will not fall by 50-60% unless there is a market crash. Next company is Relaxo, and number of shares are 10. Currently it's in negative -12%, which is absolutely fine. It's just a temporary fall. Company is down temporarily. This company is the market leader in the footwear sector. You can continue to hold this for long term. It's a very good company, and it's surely going to recover this loss plus provide you better return. Next company is Reliance. Again, it's a very good company, but the problem is still the same. The quantity in the good companies is very less. So in this company also, you can think of doing more allocation. Next company is SBI Card, and the number of shares are 5, and it is currently down by around 2%. You can hold this company. It's a good company showing good profits, and in the long run it can provide good returns. Next company is Seacoast, and the number of quantities is very good in this case. Why? Because the share price is very less. But even with less share price, you will see that this company has fallen by 76%. So the idea or the logic should be not to look at the share price, but to look at company's business. Because share market will give you return in terms of percentage. It will not see whether the share is of 10 rupees or of 10,000 rupees. This is also one of the common mistakes which the new retail investor are doing, that they go after the share price instead of going with the share business. In this company, if I were you, I would have booked losses, invest in some other company. Next company is Tata Consumer. Number of shares are 13 and currently down by 4%. This is a good company. You can continue with this. In the FMCG sector, this company has provided very good returns, better than companies like HUL, Dabur, Marico. Next company is from the auto sector, Tata Motors, and number of shares are 16 and it is currently down by 18%. If you believe in the EV narrative, you can continue with this company as well. But overall, if I talk about the auto sector has not provided very good returns in the long term. It has mostly been cyclical, and it is also governed by a lot of regulations, policies as well. Next company is Titan, and then quantity is 5. This is a very good company belonging to the jewelry sector. It is a leader in the jewelry sector. Currently it is giving a positive return of 7%. For this company, obviously you can continue. If you want, you can even add more and increase the holding to 10%. Next company is TTK Prestige. The company's business is good, but in terms of sales, profit and the stock price CAGR, this company has not provided very impressive returns. If you want, you can move your capital from this company and increase the holdings in other market leaders which we have discussed, like SDFC, Titan, Bajaj Finance, Berger Paints, Relaxo, Polycab. Next company is IEX, and it is currently showing a negative return of 30% in the portfolio. This company became favorite of retail investor. Why? Because post-COVID, the share price of this company started zooming up very quickly, and that is when it became the favorite of retail investors, not because of the business that it was doing, but because of the share price movement which we were seeing in the stock price. For this company also, if I were you, I would have directed my money from this company to other companies, because nobody knows that for how much time these companies are going to stay at these level. Next company is Infosys, and in this again you will see the same pattern, that a good company with less quantity of shares. You can definitely continue with this company, a very good company, and also think of increasing the allocation. Next company is Jubilant Food. Number of quantity is 20 and it is currently giving -22% return. This is a good company. You can continue with this. It holds the franchise for Domino's, Dunkin' Donuts, and their business is going to increase in the future as well. So you can continue for long term in this company. Next company is KPR Mill. Number of quantity is 10. It is currently giving a negative return of 14%. This belongs to the textile sector, and textile sector, my friend, has not given consistent return in their past history. So for this also, if you want, you can think of diverting your funds. Next company is Motherson Sumi. This belongs to the auto ancillary sector. This is a good company. You can continue for long term. And the last company is Pidilite. Again, one quantity, return is 14%. And this is the pattern you must have noticed in this portfolio, that there are market leaders in the portfolio, there are good companies in the portfolio, and most of the good companies are in positive only. But the allocation that has been done for those companies are very less. What needs to be done in this portfolio is the number of companies needs to go down, the allocation to the market leaders which are there in this portfolio needs to increase. And if you want, you can keep the number of companies to 12 to 15 also. Or if you want, you can even reduce it and move it below 12. Because again, the idea is not to have multiple companies in the portfolio. The idea is to get the return from the companies. Try to have less companies in your portfolio, but have companies on which you have super confidence, so that when they even fall, then you are confident and you can add more of those companies. So that's it in this video. If you like the video, then do hit the like and subscribe button. Or if you have any suggestion, then please feel free to mention it in the comment box. Thank you.